Hey Harvesters, and welcome to Project Premium Harvest. My name is Matt. In today's video, we're going to be discussing three different topics. The first topic we're going to discuss is my SPY covered call strategy that I'm running every single day to produce a daily income. The second thing we're going to talk about is the Kurv Group 3 funds. And then the third thing we're going to talk about is the RoundHill weekly pairs. The distributions came out for the Kurv and the RoundHill funds. So we're going to discuss the declarations, if the funds are good investments, total return if we invested at the inception price, and total return if we invested at the all-time high, would we still be making money? So let's get going. You guys know me. The first thing I like to talk about is the account value for my portfolio, because I am an investor and I am in the trenches with you guys. Current value is $87,117.63. Now let's go over to my daily covered call strategy. All right, guys, now let's take a look at this April 15th section. A couple of notes I want to point out before we talk about the covered calls is when the SPY opened this morning, 6:30 Pacific Standard Time. I'm on the West Coast. The share price for SPY was $539.51. So the way I like to run my covered call strategy is I like to choose a premium that is somewhere between $5 to $10 away from this $539.51. So for today, I settled on choosing a strike price of $5.44. The market was looking relatively weak in the morning. Usually when the market comes out red, from my experience, it ends the day red or at neutral. So therefore, I decided to choose a more closer strike price to the active trading price of a $5 difference. So then I went off of that. So then I did two contracts. Both of them strike price $5.44. The first contract I made $116, and the second contract I made $108 to then total $224 on the day. Guys, I was invested $60,000 into XDTE, and this is what 1 week of premium was worth in addition to the NAV erosion. I made that in 1 day, no NAV erosion, and then I could take this cash and then buy more SPY with it. Since I started doing this covered call strategy, I actually have back on Tuesday last week. So it's been 1 full week since running this strategy, but I've only traded on 3 days because I took a break on one of the days, waited for the market to go down, and then I bought some more shares. But in total, for 1 week of trading, I made $2,276.03. As a thought exercise, I multiplied that by 4 and came up with $9,104.12. So I continue this strategy as is. Over a month period, I'm going to make $9,104 with limited to zero NAV erosion. And then over a year period, this is what the numbers would look like. $109,249.44. That's only having that's only owning 200 shares of SPY. I plan on buying another 200 shares sometime within the next 90 days. I think the market's going to go down a little bit more. I think I might try to jump in at the 522 strike price to get 100 more shares. So that'd be 300. And then maybe after this 90-day tariff thing, we'll see how the market's looking. Might throw another 100 shares in because I still have over $180,000 of margin available. And then I'm also selling a property that I own. And then eventually I should make somewhere between $60,000 of profit. So then I could buy another 100 shares. So by the end of this year, I may have 500 shares of SPY that I can be running a covered call daily strategy against, and this numbers could potentially be higher. There are two negatives towards this strategy. One, I'm going to be paying taxes at ordinary income or short-term capital gains, which is ordinary income. And then the potential problem number 2 is if the market continues going down and say I bought 100 shares of SPY at the 540, 100 shares of SPY at the 527, if SPY shoots down to like the 500 flat or 475 or 450, the amount of premium I'm going to be getting running this covered call strategy may not be worth it. And I will be getting 0 to very low premium, which is a potential risk factor running this strategy. Nobody has a crystal ball. I didn't time the market. I just thought I would buy SPY at this current price because for what it's worth, it is a relatively great price. However, there is potential for more downside. So there is that risk. However, I am willing to risk it because I am relatively young. And if something bad happens, I'll have plenty of time to recover. But if you are more fiscally responsible or don't really have the risk tolerance because you are closer to retirement or that you are depending on this income to like sustain your bills, maybe this might not be the greatest strategy, but just throwing out a couple of different ideas out there. For me, I'm young. This $109,000 for only owning 200 shares of SPY seems quite great. And I will say this, Maybe last week was an anomaly because I basically made about $688 of premium, but then I made $924 of appreciation because my shares were assigned because they met the strike price. So therefore, maybe that might not happen this week, but I only traded 2 days last week. And if I traded maybe 3 more this week, the numbers could look pretty similar. Before we go over to Kurv and yieldmax, declaration, fund performance, and things of that nature, I want to discuss how I'm actually running these option strategies. So I'm going to go over to SPY. We're going to go over this section that says trade options. And what we're trying to do is, because I own 100 shares of SPY or 200 shares of SPY, I'm going to be trying to sell covered call. So sell your call. The way options works is if you own 100 shares of the underlying, so I own 100 shares of SPY, that's 1 contract. If you own 1,000 shares of SPY, that's 10 contracts. So 100 shares, 1 contract, that's how it works. And the way I operate is I choose a strike price that is $5 to $10 away from the current trading price of SPY. So when the market opens in the morning, for April 16th, it's going to be somewhere around $533.28. I'm going to choose a strike price that's either $5 to $10 above. 10 is kind of just an arbitrary number. It was kind of a range. I'll choose anything further away, but 5 is kind of like the minimum threshold I am willing to part with my shares if the strike price is reached and is assigned. So if we add 5 to 538.28, that's roughly the 538 strike price. And that premium is going to be $321 per share. So if I were to run my 2 contracts of SPY, I would make $642 off of running this option. So that's kind of a lot of money. However, when the morning happens, this number is probably going to be cut in half. And then I'll reevaluate the strike price I'm specifically looking for and the premium. So there's like, in my other video, I use a leverage analogy where if you want more appreciation, then you're going to get less premium. If you want more premium, you're going to get less appreciation. And that's just how the lever works. It's inverse to itself. Somebody also asked, do I look at the chance of profit? I never look at that. I just look at the share price and I'm trying to guesstimate where SPY is going to end up in the day. So I think because of how SPY traded today, unless there's some news that changes the market conditions, I think SPY is going to continue going down. So I'd be willing to run a $5 away from the current trading price so that I would get this $321 of premium. But there's also another consideration. Depends on at what price did you buy your SPY shares. So one set of my SPY shares I bought at the 527 range, so about $527 per share. So if this 538 got assigned, I would be positive appreciation and then I'd be positive premium. However, the other 100 shares of SPY that I currently own, I bought at the 540 range. So basically, if I chose this 538 and that those share price got it and the call got assigned at that 538, I basically would lose $2 times 100 shares. I basically would lose $200 in the appreciation, or I guess it would be depreciation, but I would lock in that premium. So ideally, so I don't lose money, I would actually choose a strike price that's at the 540. So I'd pretty much run 1 contract at the 538 to get this $321 of premium. And then I would probably choose maybe the 540. I'd probably choose the 541 because I bought the shares at like 540.70 or something. So to be safe, to lock in premium, and then to also make sure I don't lose money, I'm choosing the strike price that is above what I bought in at so that I can lock in premium, make sure I don't manifest a negative loss in appreciation, and then go from there. So that's kind of how I run options. This whole point of this strategy is I don't want NAV erosion. I don't want to lose money. And I'm just going to hold on to the fund until it does make money. All right, guys, the first Kurv fund we're going to talk about for the group 3 payers is AAPY. Exception price was $25 a share. The all-time high appreciated to $29.10. The declaration and distribution payment for April 17th is going to be 25 cents, and the current trading price is $21.65. Now let's go over to the fund holistics and make a determination, good investment or bad investment. The total premium since this fund has been incepted paid out $6.38 a share. there have been 18 payments, and the average distribution per payment is about 35 cents. If you look at the share price change in value, if we invested at the inception price, it's going to be negative 13.40%. However, if we throw in the premium in addition to that share price, it's actually positive 12.12%. And if we compare that to AAPL, which is the actual underlying Apple, we compare 8% to 12%. Kurv actually outperformed Apple. If we invested at the all-time high, which was that $29.10 range, the share price percentage is negative 25.60%. However, if we did add in that total premium to that share price, it's negative 3.67%. And if we compare that to Apple actual, it's negative 25%. So if you invest it into Kurv, you have done a better job than the actual underlying, which was, it's always quite interesting when we look at it like this. If you look at the average share price for AAPY, it's about $25.61. Now let's go over to Goop. For Goop, the inception price was $25 a share and the all-time high was $32.66. The declaration and distribution payment for April 17th is going to be 35 cents a share, and Goop is currently trading at $23.97. The total premium since this fund has been incepted paid out $6.27, and that has paid out 18 different times. The average distribution for Goop is almost 35 cents a share. And if you look at the share price change in value since the inception, it's negative 4.12%. And if we throw the total premium in addition to that share price calculation, we're actually positive 20.97%. And if we compare that to Google actual, Google was at 14%. So if you invested into Goop, you actually outperformed the underlying by 6%. And that's one of the reasons why during my great reset, I didn't completely sell out of all of my Kurv and RoundHill. I just lowered my investment threshold because I was just going to make more money running SPY covered calls. Looking at the share price changing value, if we invested at the all-time high, it's negative 26.61%. But if we look at the total return, taking that premium in addition to that share price, it's negative 7.40. However, if we compare that to the Google underlying, it's negative 24%. So same thing. You were not affected as much if you invested into Goop versus the underlying. The average share price for Goop is about $28.25 a share. All right, guys, kicking off RoundHill funds, we're going to do rdte. The inception price was $45 a share and the all-time high was $45.65. For the April 17th distribution, we're going to get paid out 23 cents a share, and rdte is trading at $31.05. The return of capital is 100%. So that means this entire distribution is helping to lower your cost basis. Eventually your cost basis will get down to zero. And then after that point, depending on if it's been 1 year or a year plus, you're going to pay taxes at the short-term or long-term capital gains. Now let's look at the fund holistically. The total premium this fund has paid out is $8.71, and the number of distributions has been 30. The average distribution per payout is about 29 cents. And if you look at the share price changing value since the inception, it's negative 31%. And if you look at the total return, basically taking that premium, throwing it in the share price, coming up with that formula, it's negative 11.63%. If we compare that to IWM, that's basically the Russell 2000 from iShares, it's negative 11%. So rdte did a little bit worse by 0.63%. But for me, we'll chop that up to even. For the share price change in value, if we invest at the all-time high mark, it's negative 31.98%. And if we look at that with including premium, that's negative 12.89%. And if we compare that to investing into IWM at the all-time high, it's negative 23%. So in this regard, rdte did a lot better job than the underlying. So that's a passing grade, good for it. If this is a good fund to invest in, hard to say. I'm seeing two negatives, never a good thing. The average share price for this fund is about $40.67 a share. Moving on to XDTE. I currently am still maintaining about a $5,500 investment of it, but I did reduce my holding a significant portion because of the great reset. I decided I was going to make a lot more money running daily covered calls against the SPY than owning rdte and XDTE. So completely sold out of rdte, and the XDTE, I sold out about $45,000, almost $50,000 worth of those funds. I still think there's a use case for them. That's why I haven't completely sold out, because I still like these funds. I still like what they have to offer. And it's also too early to tell if these funds are going to be successful. This might actually outperform the SPY. We just don't know it. Let's dive into the numbers. For XDTE, inception price $52, all-time high $53.57. The April 17th distribution payment is going to be 23 cents a share, and the current share price is trading at $40.65. Just like rdte, it is a 100% return of capital. So this entire distribution is helping to reduce your cost basis to the point where eventually it'll be at zero, and then after, so you don't pay taxes until it's at cost basis zero, and then after 0% or zero cost basis, then you pay short-term or long-term capital gains. Short-term capital gains is ordinary income, if you didn't know that. Looking at the fund holistically, it has paid out $14.05 a share, and it has paid out 56 times. Each distribution payment is about 25 cents a share, and since this fund has been incepted, it's negative 21.83%. Not a very good number, but if we look at throwing in the premium in addition to that share price, we're actually positive 5.21%. And if we compare that to SPY, it actually outperformed the S&P 500, which was quite interesting. However, I think if you ran covered call strategy, it might be a little bit higher. I might be biased, or I just might be the honeymoon phase of doing covered calls. Continuing forward, the all-time high, if we invest at the all-time high, we'd be negative 24.12%. The total return would be 2.12%. And if we compare that to SPY, if we invest at SPY at the all-time high, it's negative 12.47%. So investing into XDTE did a better performance than investing at the SPY at the all-time high. So that's why I'm still investing in XDTE. There is a use case and long-term, how would you say this? There is long-term potential for holding into this fund, and that's why I'm going to do that. Average share price for XDTE is $50.74 a share. Moving on to the next fund. The next fund is QDTE, inception price $45 a share, all-time high $45.98. The April 17th distribution payment is going to be 20 cents a share, and it's currently trading at $31 a share. Just like the previous two funds, it is trading at a 100% return of capital. So this entire distribution is helping to lower your cost basis to zero, and eventually that means no taxes for now, but then eventually once your cost basis is at zero, then we are going to be paying tax at short-term or long-term capital gains. Moving down to the fund performance, this QDTE has paid out $16.62 a share. The number of distributions has been 56, and the average distribution payment for this fund is about 29 cents per payment. If we invested in this fund at the inception price, would be negative 31.47%. But if we kept the premium in addition to that share price, we're actually positive 5.82%. And if we compare that to QQQ at the 1.8%, the QDTE performed better than the underlying. Moving over to the share price change in value, if we invest it at that all-time high, ATH, it's negative 33%. And then if we look at that total return, basically taking that premium, throwing in that share price, coming up with that formula, it's positive 3.57%. And if we compare that to QQQ, all-time high, it's negative 16.22%. So owning QDTE and investing at the wrong time did a lot better than investing in the underlying at the wrong time. The average share price is $41.57. All right, lastly, we are going over to YBIT. I recently bought about $2,000 worth in my Roth IRA and just plan on reinvesting every single distribution and holding on for dear life as Bitcoin does its movements. So for YBTC, inception price $50 a share, all-time high was $55.52. The April 17th distribution payment is going to be 44 cents a share, and the current share price is trading at $41. The return on capital is quite interesting. It is 100% for a crypto covered call fund or crypto options fund. Interesting. So what this means is that 44 cents is going to lower your cost basis down to zero eventually. This, if it's in a non-taxable account, if it's in a tax advantage account like a Roth IRA or traditional, you don't have to pay taxes. But if it's a normal brokerage, this matters. Cost basis matters. Moving on to total premium, since this fund has been incepted back in January 2024, it has paid out $29.19 in premium. The number of distributions is 28, and the average distribution is about $1.04. The share price change in value since inception is negative 18%. However, if we throw in that total premium in addition to that share price, it's positive 40.39%. If we compare that to BTC from about a year ago, BTC is crushing it at 99.24%, so it's almost 2.5 times more appreciation. However, if we look at the share price change in value since the all-time high, so we invested at the worst time or at the high, it's negative 26.15%. But if we throw the premium in there, positive 26.43. And if you look at Bitcoin since that, if we invest at that all-time high, it's actually negative 21.08%. So owning YBTC is a better investment than Bitcoin, depending on when you buy. The average share price for YBTC is $47 a share. That wraps up the video. Let's go over to the RoundHill view and I will give you my final thoughts. All right, guys, here are my final thoughts for this video. The daily option strategy against SPY is working pretty good. It is a slight concerning that the market's going back down. So some of my investments or my 100 shares of SPY that I bought at the 540 might not necessarily be paying out too well in the future, but this does bring opportunity for me to invest another 100 shares of SPY because I have the buying power available to do that. So that's something I'm looking forward to in the future. Maybe not necessarily tomorrow, maybe not necessarily a week from now, but a couple of weeks down the line. Also keeping another 100 shares of SPY on the reserve to see how this pause in the tariff is going to affect the market from 90 days from now. So I want to be very flexible to make it play potentially 90 days from now. If there's a huge dip in the market, I'm definitely going to jump in on that. Or if it goes up, I might be patient to see what the economic indicators will look like. As far as the Kurv funds, AAPY is doing pretty good and Goop's doing pretty good. One of the reasons why I still stayed invested into Goop is because the fund performed better than Google, the actual underlying. So long term, just investing in this and having the distributions of premium reinvest in itself, I think it's going to be a great thing. So that's one of the reasons why I like to hold onto some of these high income ETFs, amzp, Goop, and XDTE. I think they do have long-term potential in a downward market like it is right now. They have outperformed the actual underlying, which is quite impressive. As far as the RoundHill funds, I think if we look and compare and contrast the three different funds like the rdte, QDTE, XDTE, QDTE slightly is a little bit better on the total return. However, if we look at all the four funds and adding in that crypto, YBTC is the winner. I do own $2,000 of YBTC. So everything in this video so far, I pretty much have a little bit of investment in. Yeah, guys, that wrapped up the video. Hopefully your portfolios are doing great out there. Hopefully me running this daily covered call option strategy against SPYs, maybe getting the juices flowing and getting the thought process flowing. And it might be a better position to invest if you have the capital to own 100 shares of SPY. Problem with this strategy is you have to have the capital to run the daily covered calls. Otherwise, you might have to just choose another underlying that isn't, $540 a share so that you can just run weeklies on it. I hope you're doing well. Matt out, and I will see you at the next video.